So in today's session, we are going to discuss one past paper question with all of you. Okay. It has a good volume of theoretical discussion as well as a good volume of practical discussion. This question is from September-December 2018. We will do that question in this class, revise some stuff as well, and teach you different concepts as well as this past paper question so that you are up to date with it. Okay. It's a 50-mark question from September-December 2010, and the name is KINGTIM company. So it's in your screens, in front of your screen. And if you want to open it on your devices, you can just go in Google and write ACCA AFM KINGTIM. The question will come in front of you. Okay. Okay, so let's start doing this past paper question. The question name is KINGTIM company. It's a 50-mark question. Okay, and we will do this 50-mark question. Yes, Aurangzeb, we will share the recording in the group. Just join the WhatsApp group. Okay. The question states, KINGTIM company is a nationwide chain of garden centers selling products such as plants, fertilizers, tools, and garden furniture. Okay. So KINGTIM is a nationwide chain of garden centers. It's a chain of garden centers. Okay. It was established 20 years ago by the current team of executive directors and achieved a listing on its local stock market 4 years ago. Since the listing, the company has made consistent profits and has been able to increase its dividends each year. The executive directors collectively own between them 25% of the issued share capital. Remaining shares are held by a number of investors, with none of them owning more than 10% of the issued share capital. Okay. It has provided you some background stuff, which you have to focus on, and you have got an understanding of this, that what is KINGTIM company trying to do. This is a very important stuff, because unless you know what the company is doing, you won't be able to answer properly the, what do we say, theoretical issues, specifically the theoretical issues. Okay. So that's what we have to focus on. So I think the first paragraph is clear to everyone. There's nothing new that KINGTIM is a nationwide chain of garden centers. It sells products like plants, fertilizers, tools, garden furniture. It was established 20 years ago by a current team of executive directors, achieved a listing on stock market 4 years ago. Since listing, company has made consistent profits and has been able to increase its dividends each year. Executive directors collectively own between 25% of the issued capital. Remaining shares are held by a number of investors, none of them owning more than 10% shares. Two of KINGTIM's major competitors have been taken over in the last 2 years. Okay, so KINGTIM is a garden center. Two competitors have been taken over. Okay, media coverage suggests that further takeovers are possible. Potential acquirers include other chains of garden centers, property developers, supermarket chains looking to diversify their business into profitable garden center sector. As yet, no potential acquirer has approached KINGTIM to buy the whole chain, although KINGTIM has had inquiries from other businesses wanting to purchase individual garden centers. KINGTIM can sell a number of individual garden centers without threatening its continued existence. Okay, so this is an interesting paragraph, that two competitors of KINGTIM have been taken over in the last 2 years. Media coverage suggests that further takeovers are possible. So potential acquirers want to diversify and enter into this garden center sector. As yet, no potential acquirer has approached KINGTIM. So KINGTIM hasn't been approached by any, but KINGTIM has inquiries from other business wanting to purchase individual garden centers because it's a nationwide chain. So no one has come to acquire KINGTIM completely, but there are inquiries of individual garden centers. KINGTIM can sell a number of individual garden centers. It can sell individual garden centers without threatening its continued existence. Like KFC is a brand, it has a number of chains. No one has approached KINGTIM like KFC to get the whole brand, but individual branches offer keep coming. Takeover defenses. KINGTIM's executive directors remain committed to the business. They are fearful of a takeover, that okay, two of our competitors have been taken over. They fear takeover. Believing that the new owners will want some or all of them to leave the company. They are fearful because they fear that the new owners will want some of us to leave the company. They have therefore been considering possible defenses against a takeover bid. KINGTIM CEO has received 2 proposals from directors. You know, there is a topic in mergers and acquisitions, defenses against takeover bids, the white knight strategy, the poison pill strategy. If you have read the Kaplan book, okay, or taken lectures from somewhere, I don't know. Students who have studied from us, they know this. Okay, so KINGTIM's executive directors remain committed. They are fearful of takeover. Fearful of takeover means they don't want the takeover to happen. So they are considering possible defenses against takeover bid. They are considering possible defenses against takeover bid. KINGTIM CEO has received 2 proposals. Sell individual garden centers, which would be particularly attractive to purchasers. Disposal of these centers would make KINGTIM company overall less attractive purchase. Okay. So the first proposal is don't sell the brand. What is the defense? Sell individual centers. Okay. So when you sell individual centers, the KINGTIM company overall would be a less attractive purchase. How selling individual centers would make it a less attractive purchase? How can it be a defense? Let's suppose KINGTIM has 100 branches. KINGTIM has 100 branches. The first proposal is sell individual centers. For example, someone is coming and say, oh, KINGTIM is a big brand. It has 100 branches. Sell individual centers. Let's suppose sell 60 individually. This makes KINGTIM less attractive to potential buyers. That's a defense, because now the potential buyer will say, oh, it's not a big brand. It has only got 40 branches because 60 are already sold individually. So he may not acquire KINGTIM. It can become less attractive. This is the first defense which they are considering, sell individual branches. Second, pay the executive directors higher remuneration and change their contracts so that they would receive much higher compensation for loss of office if their contracts were terminated early. So pay the directors higher remuneration, change their contracts so that they would receive much higher compensation for loss of office if their contracts were terminated early. Now, the second proposal which they're considering is that pay directors higher remuneration and change their contracts and add a clause that we will pay them higher compensation if they lose office, if the contracts are terminated early. How this would be a defense. If you change their contracts, that directors' contracts are terminated, they will receive a huge compensation. The potential acquirer may think, okay, if I acquire this company, there is a clause that if I remove the directors have to be paid a huge compensation. He might get afraid, okay, who will pay so much compensation? Let's just leave it. So this can be also a suitable defense. Okay, so the company fears takeover. To prevent the takeover, they have made two strategies in their minds. The first strategy is sell individual centers, okay, so that you are left with less centers and the acquirer says, okay, it's not a good company, not a big company, in fact. And second, higher remuneration to directors and change contracts that we will give you much higher compensation if the contracts are terminated early. A potential acquirer will think, okay, if I acquire them and remove the directors, there is so much compensation, leave it. KINGTIM Company's chief executive believes, however, that any defense KINGTIM adopts should also strengthen the company's future. She is therefore proposing to expand the company's current limited sales of camping products in its garden centers by establishing a chain of KINGTIM outdoor shops selling camping, walking, and other outdoor equipment. The outdoor retail sector is competitive, but the CEO believes that KINGTIM will be successful. The establishment of the chain of outdoor shops will be funded solely by debt. The idea being that changing KINGTIM financial structure by having sufficiently more debt would make it less attractive to acquirers. Now, CEO believes one more thing, that if we make this defense successful and the acquirers run away, our future needs to be strengthened. Okay. She is considering a proposal that we should expand our sales, establish chain of outdoor shops as well, involving camping, walking, other equipment. Outdoor sector is competitive. CEO believes that we will be successful. Establishment of outdoor shops chain requires money. It would be funded by debt. And the idea is that if we will have more debt, a highly geared company, a highly debt company would again make it less attractive to acquirers. Okay. Financial details. KINGTIM currently has $25 million in shares in issue with a current share price of 5.56 per share. It also has 0.45 million, 6.5% bonds in issue. Each bond, 6.5% bond at a par value of 100, is currently trading at 104 per 100. The premium on redemption of bonds in 3 years' time is 2%. Based on a yield to maturity approach, the after-tax cost of the bonds is 4.1%. After-tax cost of bonds is KD1 minus T. Bonds after-tax cost KD1 minus T is 4.1%. KINGTIM's quoted equity beta for its existing garden center business is 0.9. So for existing garden center business, the beta equity is 0.9. KINGTIM plans to issue 0.6 million, 7.5% new bonds, each with a par value of 100. The bonds will be redeemable in 4 years' time at a premium of 8%. The coupon of these bonds will be payable on an annual basis. The bonds are anticipated to have a credit rating of BBB negative. The issue of new 7.5% bonds will not affect the market value of KINGTIM's share or existing 6.5% bonds. You know, to establish chain, it was wanting to raise a debt. So how much debt it wants to raise? KINGTIM plans to issue 0.6 million, 7.5% new bonds with a par value of 100. Bonds will be redeemed in 4 years' time at premium of 8%. The coupon interest on these bonds will be payable on annual basis. Bonds will have a credit rating of BBB negative. The issue of new 7.5% bonds will not affect the market value of shares or the existing bonds. It already has existing bonds and shares. So issue of new bonds would not affect the market value of shares or the existing bonds. The market value of the new bonds will be determined by using information relating to KINGTIM's credit rating and the 4 bonds which the government has issued to estimate KINGTIM's yield curve. How will you compute the market value of the new bonds? It's saying that the market value of new bonds will be determined. The market value of new bonds will be determined by using information relating to KINGTIM's credit rating and the 4 bonds which the government has issued to estimate KINGTIM's yield curve. You will compute the market value of bonds by using information relating to credit rating, which is BBB negative, and the 4 bonds which the government has issued to estimate KINGTIM's yield curve. All the bonds are of same risk class. Details of bonds are as follows. The bonds are GATHDERO4 bonds. The annual yield is 4%, 4.3%, 4.7%, 5.2%. They are redeemable in 1 year, 2 year, 3 year, 4 year. The 4 bonds are issued by government. So the rate on these bonds can be believed to be RF. The market value of bonds will be determined by using information relating to Kingdom's credit rating and the 4 bonds which government has issued. These bonds are issued by government. So the rate is RF. It's redeemable in 1, 2, 3, 4 years. And the spread in basis points is as follows. For this 1-year bond, the spread is 56 basis points. For this 2-year bonds, it's 78 basis points. Whereas 3-year bond, it's 106 basis points. And for 4-year bonds, it's 135 basis points. Okay. So in this, it gave you information about the current structure as well as the new bonds which you are planning to issue. KINGTIM plans to invest $60 million in non-current assets for the outdoor shops. Working capital requirements can be ignored. Currently, KINGTIM's non-current assets have a net book value of $150 million and it plans to invest $60 million more. It is assumed that the proportion of book value of non-current assets which will be invested in the outdoor shops and the garden center will give a fair representation of the size of each business within KINGTIM. KINGTIM plans to invest $60 million in non-current assets. Okay. KINGTIM's current non-current assets have a net book value of $150 million. It is assumed that the proportion of book value of non-current assets which will be invested in the outdoor shops and garden center will give a fair representation of size of each business unit. So whatever non-current assets are invested in each unit, that represents the size of each unit. Okay. The asset beta of similar companies in outdoor retail sector is 0.88. So beta asset of outdoor sector is 0.88. You know, the outdoor sector is something which companies going inside. Companies planning to launch outdoor center. So outdoor sector's beta asset is 0.88. Before taking into consideration the impact of this new investment, KINGTIM's forecast pre-tax earnings for the coming year is 24 million. So before taking into consideration this new investment, the pre-tax earnings is 24 million. That's pre-tax profit. It is estimated that the new investment may make a 10% pre-tax return. Corporate tax rate is 25% per year. Risk-free rate of return is 4% currently and premium is 9%. Employee remuneration. KINGTIM's company annual report contains a general commitment to act with social responsibility in line with society's expectations. It also commits to paying its staff fairly in accordance with their responsibility and then states that its staffs are vital to success. To try to improve the situation of low-paid employees, the government has recommended a basic hourly wage as the minimum level employees should be paid, although this minimum is not legally enforceable. A newspaper investigation has revealed that some staff in KINGTIM's garden centers in the northern region of country are paid up to 15% less per hour than the recommended minimum wage. Most of these staff are part-time staff working limited hours. So government wants a minimum wage, but 15% less is being paid to some of the staff. The manager of KINGTIM's northern region centers, when asked to comment, stated that KINGTIM had obligations to its shareholders to control staff costs. Lower pay levels were necessary to differentiate between staff, ensuring managers and staff with experience and expertise were appropriately rewarded. Manager commented that pay levels also reflected the lower commitment to KINGTIM, which part-time staff made compared with full-time staff. So when the northern region centers were asked to comment on these lower staff pay levels, they said that we had to control staff costs and employees with expertise and experience have to be paid more, others less, etc. Obviously, we will read this stuff again when the relevant requirement comes. For the time being, requirement A. Discuss the feasibility and effectiveness of the defense strategies of selling off individual garden centers and enhancing directors' remuneration. Okay. If you remember the question, the company was fearful of takeover. If you remember the question, the company was fearful of takeover and it had two defense strategies in mind. First, sell off individual garden centers. The company thinks that if they sell off individual garden centers, the potential acquirers will run away. It's a defense. How? Let's suppose company has 100 garden centers, it's a chain. Someone comes and acquires our whole brand, thinking they have 100 chains. They can easily acquire us. We are attractive for them. But if we sell individual garden centers, like let's suppose we sold 40 garden centers, the potential acquirers may run away. They may say that, okay, it's now just left at 60, not a good brand. And the second strategy, defense strategy, which they are considering was enhance director remuneration. Because they think that if they enhance remuneration and enter a clause that if their contracts are terminated early, they will get a huge compensation, the potential acquirers may run away, thinking that if someone acquires this, acquirer may think that if we acquire this company, we have to pay so much compensation to directors. If we want to fire them, too much costly, leave it. So two strategies are being considered by the company, and requirement is discuss the feasibility and effectiveness of defense strategies. What are the defense strategies? Selling off individual garden centers and enhancing directors' remuneration. Now it's 7 marks, easily 3.5 marks each. You can discuss the feasibility and effectiveness of this first defense strategy, sell off individual centers, and second, enhance directors' remuneration. And when you are asked to discuss feasibility and effectiveness, you can write your heart out. What you think, what people do. Okay, this was written in the book. Just quickly read the examiner's answer. Okay, examiner answer should always be read at the second number. First, think of yourself that your company has is fearful that someone might take over them, and you fear that someone might take over, so you have a defense strategy. So defense strategy is, okay, let's sell off individual centers so that our centers get less and we get less attractive. Okay, what is the feasibility and effectiveness of this defense strategy? Do you think it is workable? Write pros and cons, whether it is effective or not, whether it is feasible or not, whether it is workable or not. Okay, so let's just discuss and then we will read the examiner answer. Okay, so what do you think if the company doesn't want to get taken over by someone? Okay, the company doesn't want to be taken over by someone and they have some defense strategy in mind. The first strategy is sell off individual units. Okay, what do you think the feasibility and effectiveness of this strategy? Now, in my opinion, this strategy doesn't seem too good. In my opinion, this strategy doesn't seem too good. Why? Now I have written that it's not good. I have to justify. Okay, 3.5 marks. I have to write 3-4 points. Because if you sell individual garden centers, okay, individual garden center selling means you will get cash in return. Cash will increase the cash surpluses, the reserves of the company. So those cash reserves may become attractive for a potential acquirer. They may say, oh my God, this company has so much cash. Let's just get it. Okay, so this cannot be a good solution because this will result in sale of individual center. And sale of individual center means that you get cash surplus created. It becomes more attractive, but it can be good as well. This strategy can be good as well. If I write it's good, I have to justify. If we sell this business, individual garden center, the profitability will go down. The profitability will go down. And when the profitability will go down, the potential acquirers will run away. While selling these individual centers, obviously not all chains are successful. Not all chains are successful. Some branches are successful, some are not. While selling individual garden centers, if we sell the most profitable one, the potential acquirer may say, okay, they have sold the most profitable ones. That means they don't remain a good business. Leave it. Okay. The potential acquirers may say, okay, individual centers are being sold. That means the other centers will also start expecting. If we sold 30 centers, the remaining 70 may expect that we will also be taken over. So they may start working with demotivation. So this is not a good company, just leave it. That's it. I've discussed the feasibility and effectiveness. Sir, you have stated sometimes it's good, it's not good. That's what you have to do. Why do you want to stick to one point in the exam? That either it's good or it's bad? No, write both. So you see, I firstly wrote it's not too good. Look at the points for 3.5 marks. What did I do? I first wrote it's not good because it will create cash surplus and potential acquirers may come thinking it's a cash cow. Then I wrote it may be good. Profitable centers gone. It says, okay, now only the less profitable centers are remaining. The potential acquirer may run away. The profit will go down because less centers will less profit. Potential acquirer will go away. He may think the other centers will get demotivated. He may run away. So I wrote 4 points. That's enough for 3.5 marks because you at least get one valid point for one valid mark. Okay. But what about the strategy of enhancing directors' remuneration? What do you think about that? That if they enhance directors' remuneration, increase their pay, and mention in the contract that if someone takes over us and fires them, they have to pay heavy compensation. Since this contractual clause of heavy compensation will be seen by potential acquirers before that, they may decide not to go in this company because if we'll acquire them, we have to pay so much penalty, so the directors leave it. Is this successful or not? Okay. Now, at first sight, it seems that it will be beneficial. At first sight, it may seem it will be beneficial. Why? Because this puts an additional burden. This puts an additional burden on the potential acquirer. He just does not have to buy the company. After buying the company, to remove the directors, he has to pay heavy compensation. So it's an extra cost. This extra cost may demotivate him. Leave it. So maybe a good option. Okay. It may be a good option as well. It may be a bad option as well. Okay. So how can it be a bad option? The potential acquirer may think, let's acquire this company and keep the existing directors. Okay. But strip them of their authority. Don't involve them in decision making. Okay. So a potential acquirer may think, okay, I won't compensate them. I will take over the company and for 1 or 2 years, let's just keep those directors. Don't remove them. Don't bear compensation costs, but don't involve them in any affairs. Sooner or later, they will say, okay, we are not being involved in any affair. Let's resign. So compensatory costs will be saved. So you have to discuss both sides and you wrote the answer. But when I will take you to the examiner answers are usually lengthy. Those are ideal answers. Never think you can write the same level answer. Just discuss valid points like I discussed 6-7 points with you. That's enough for 7 marks. Okay. Now just giving you 4 or 5 minutes, read the answer. When I am not speaking anything, I'm just given time to read the answer. And you can listen to the recording later, because obviously we have to complete it in the specific time. Okay, now let's move towards the next parts. Next part is part B. Prepare a report for the board of directors of KINGTIM which estimates the company's cost of capital. Cost of capital is WACC before the new bonds are issued. So it is asking to calculate the company's cost of capital WACC before the new bonds are issued. Okay, so I will estimate the company's cost of capital WACC before the new bonds are issued. I will estimate the company's WACC before new bonds are issued. Okay, you see in the mid of the question there was mentioned that the new bonds were issued, so you have to find the WACC before new bonds are issued. Now, if you're asked to find the company's WACC before the new bonds are issued, okay, so you should leave this paragraph. KINGTIM plans to issue 0.6 million new bonds. Leave it. We want to find the WACC before new bonds are issued. So before new bonds are issued, make the equation of WACC. Okay. KINGTIM currently has 25 million shares in issue with a price of 5.56 per share. So KINGTIM has equity. Okay. It also has 0.5 million, 6.5% bonds in issue. It also has bonds, debt. Each bond has a nominal value of 100, trading at 104 per 100. Premium on redemption of bonds is 3 years time is 2%. And based on yield to maturity approach, the after-tax cost of bond KD1 minus C 4.1%. And quoted equity beta for garden center companies involved in garden center only is 0.9. Okay, so my requirement is WACC before issue of new bonds. So before issue of new bonds, company has two things, equity and debt. Before issue of new bonds, company has two things, equity and debt. So the equation of WACC is to be made KE into equity portion of the company plus KD1 minus T into debt proportion of the company. Right? When company has two sources, it's KE into equity portion and KD into debt portion. Okay. So we will be needing all these four things to find the WACC. Okay. Let's talk about these four things. Firstly, you will be needing E. What is E? Market value of equity, number of shares into current share price. So as you can see in the question, $25 million shares having a share price of 5.56 per share. So market value of equity is 25 million shares at a share price of 5.56 per share. So market value of equity will be $139 million. D is the market value of debt. Company has 0.45 million bonds and is trading at 104 per 100. So how much? 45 million bonds. Trading at 104 per 100. That's how you find market value, 0.45 million trading at 104 per 100. So the market value of bond is 0.468 million. Then KE, KD1 minus T. So for KD1 minus T after tax cost of debt, it's 4.1%. KE, you can find it via CAPM because equity beta is given RF plus RM minus RF into beta equity, which means you can go right at the end. The risk-free rate is 4% and the premium is 9%. So risk-free rate is 4% plus RM minus RF. The premium is 9%, beta equity is 0.9. %. You can just put all these details here. KE is 12.1% into E is 139 over 139 plus 0.468 plus KD1 minus T is 4.1%. Into D over E plus D. I don't have space, that's why I'm leaving it here. So this will give you WACC 12.06%. Copy it and you can ask any questions if you have. I just want to make a correction in it. It's written company has 0.45 million bonds and bond has a par value of 100. So the worth of this nominal value will be 45 million. Mistakenly, I wrote 2.45 million. So 0.45 million are the number of bonds having nominal value of 100. So nominal value is 45 million, trading at 104.8, 104 by 100. So it's 46.8 million. So we'll just correct it. We mistakenly wrote 0.468. It's actually 46.8. So this will produce the answer of VAC as 10.05%. For market value of debt, we take the book value of debt multiplied by 104 by 100, the market price, at what it is trading. So 0.45 million are the number of bonds and its par value of 100 is 100. So in balance sheet, it will go at 45 million, not 0.45 million. In balance sheet, the number of bonds don't go, the value goes. The D in VAC equation means market value of debt, right? So if the meaning of D is market value of debt, you should take the book value of the debt multiplied by what it is trading. So book value of debt is not 0.45 million. 0.45 million is the number of bonds. Like for example, you have two bonds, each with a value of 100. So in balance sheet, you won't write 2. You would write 200 because in balance sheet currency comes. So if you have two bonds at 100, in balance sheet you would record 200. And if they are trading at let's suppose 110 by 100, you won't multiply 2 multiplied by 110 by 100. You will multiply 200 into 110 by 100. That's what we are doing here. No, Ambika, your concept is wrong here. We need the book value of the bonds multiplied by what they are trading. Okay, so book value of bond, is it 0.45? Then you are right. No. Book value of bonds, if I have 0.45 million bonds trading at $100 in balance sheet, I will record 0.45 or 45. That's my only question with you. That's it. If in balance sheet you will record 45 million bonds, that's the book value, and it's trading at 104 by 100.